Now we have the importance of financial management. Why studying financial management is important for the firms and for financial managers, because they play a very important role inside the organization for their long-term objective to achieve their mission and vision, to achieve their objectives, that is the firm value maximization. And the importance of the financial management is that they play a very important role in all kind of businesses. It can be sole proprietorship, partnership, or corporation. Not only these, but they also play a very important role in financial institutions, banks, and financial intermediary firms. They play good role and integral part of the government sectors as well, schools and hospitals. And investment of the project is also, it is essential for the financial analyst to have a financial management education and knowledge on financial management, because for initiating a project, they need to know that what kind of the project is valuable for them, what kind of the project can have a good outcome. So for that purpose, they make some investment, and they do plant. For example, if it's a plant expansion, and for plant expansion, they will see that whether this project is giving us some benefit in future. If it's so, then they will start investment in it, and they will raise capital with the help of a stocks and bonds, or they can take help from financial institutions as well. They decide credit terms. For example, if they want to invest their financial activities, so financing their financial activities, they will decide their credit terms. How much of the credit we must, how much of the loan we must take, we must borrow, how much of the money we must borrow from the firm, and how much of the loan a company can bear, because on that basis the company is able to know that how much of the earnings they have made after the investment, and how much of the cost the investment will incur, how much of the cost. And they will analyze their total profit, what is their total profit, how much of the earnings that is made by the firm from the investment. So with the help of the financial analysis, they will understand how much of the credit terms, what are the credit terms in which they decide that how much of the who are our customers, to whom we should mm, we should uh, give our products and services on credit, and how much of the money we should give as a loan to the other companies or to the other individuals. So in that basis, financial management play a very important role. Then financial management, it is not only important in professional way, but it is also important in our for a personal decision. For example, investment of the retirement money. The individual may think that they can use their retirement money for purchasing a house, for purchasing a car, or keeping a car, or either to buy a car, or to give a car on lease. So in that basis, financial management has a integral role, and it plays a significant role. Then we have a financial staff responsibilities. Financial staff's responsibilities here, the responsibility of the financial staff is to forecast and plan, and do to analyze the major investment and financing, take financing decision. They do coordination and control. They deal with the financial markets. So forecasting and planning means that they project that how much of the money will they require in order to make a good investment, and for to have to attain their long term outcome. For that, they will make a planning. So here it's written that they interact with people from other departments to make plans that will shape the firm's future. Finance department will contact with the other departments like marketing department, their computer system department, then research and development department. So all of these departments, they interconnect with each other, and they do planning, they do forecasting, and for having a good investment in the future. Then we have major investment and financing decision. The financial staff must help determine the optimal sales growth rate, assets acquisition, and choose the best way to finance those assets. So here they will know that what is the optimal sales growth rate in which they will see that how much of the earnings that are required by the firm to increase the sales, how much is how and they will use some valuation techniques for assets acquisition and choose the best way to finance those assets. So that is done in the major investment and financing decision. Then we have coordination and control. And these, as I told you, that all the departments, they are interconnected, and all the equal the departments are equally important for coordination. So for raising a capital, it is important to contact with the other department. For example, if a company is starting a project, and marketing department will contact with the human resource department, will contact with the marketing, and marketing will contact with the finance department and R&D department, so they all are in coordination. And then when they will start and finance the project on them, a proper control system will be hired, and on that, in the proper controlling process, all of these activities are performed, financing activities are performed, and so that the final outcome is attained. Then dealing with the financial markets, as we know that what are financial markets, these are the capital markets where the buying and selling of the stocks take place. So the financial staff must deal with the money and capital markets, each firm affected by the general financial markets where the firm securities are traded. So dealing with the financial market means that where traders, they come in the they visit the physical marketplace, and they purchase securities and sell securities, from companies who have a good performance, who are the listed companies. And this is the physical marketplace where exchange of the or buying and selling of the stocks take place, not only stocks but bonds as well, where the securities are traded. So next we have a risk management. Risk management means all business face risks, and these risks can be reduced by purchasing insurance or by hedging in derivatives market. By hedging in the derivatives market. Okay, so what is the risk management? Risk management means that if we want to make an investment, then there must be some inclusion of risk, some risk involved. So to mitigate that risk or to reduce that risk, what they do, they involve in hedging, and they involve in hedging, and they try to make a diversified portfolio. Hedging means that we will study about hedging and derivative market in a very detail in the upcoming chapters. But what does hedging means? Hedging means an investment that is made with the intention of reducing the risk of adverse price movement in an asset. So hedging means that if there is a risk that a price of a commodity will rise or fall, so to mitigate that risk, or to minimize that risk, what they hedge the price of a commodity. They fix the price of the commodity. So in that case, the person who is buying an asset will be protected from a loss. In the derivatives market, uh, it is the hedging is done in order to minimize the risk of rise and fall in a price. This is basically done. Then a derivatives market, where the some uh, it's the trading of future options and swaps are done. This is the Okay, I will tell you about the derivative market. It's the financial marketplace for instruments like future option and swaps, where financial instruments are traded, such as future options and swap. This is not the chapter we will discuss in detail. It's a brief definition on derivative market. I have defined very shortly what is a derivative market. That's the financial marketplace where instruments are traded. These financial instruments are future, option, and swaps. Then we have a forms of business organization. We have a sole proprietorship, partnership, and corporation. So in the forms of business organization, we have different forms, different structures of businesses. These are sole proprietorship, partnership, and corporation. And this is the very simple review on advantages and disadvantages of the sole proprietorship, partnership, and corporation. Here, the advantages. First, we are studying about the advantages of the sole proprietorship. It is easily formed, and it only follow few government regulations and avoid companies income taxes, corporate income taxes. It avoids income taxes like it has to pay income tax, but not like corporation make income taxes payment. Disadvantages is difficult to obtain large sum of capital. It is difficult for the sole proprietor to obtain a large sum of capital for initiating a business. Um and it is unlimited personal liability. There may involve unlimited personal liability, which means that unlimited personal liability means that they are responsible to use some personal resources for pay all the liabilities. The brief definition on unlimited personal liability means that a legal obligation where a business owner is held personally responsible for all the business debts and long-term legal actions, for debts and legal actions, in which unlimited liability, personal liability means that if a person is unable to pay its liability from the business earnings, then they will pay liability from its personal resources. Now we have partnership. Partnership is also easy to form like sole proprietorship. They follow few government regulations and avoid corporate income taxes, same as sole proprietorship. And it has unlimited liability and limited life of uh, limited life. It has a limited life of business means that the life of the business is limited to the life of the owner of the business. And then difficult of transferring ownership. In partnership it is difficult to transfer the ownership. Mm, but in corporation it is easy. Once the ownership is gained by an individual, it can be easily transferred to other person by selling the security in the corporation. It is about corporation. When we talk about transferability of ownership, then we have a difficulty of raising large amount of capital. In partnership is also it's a bit difficult. It's a difficult for those who are starting business in the form of partnership to raise a large sum of capital. But in corporation it's easy to have a large sum of capital. In the corporation we have unlimited life. The life is unlimited. It's not limited like sole proprietorship and partnership, because limited life in the sole proprietorship and partnership means that the life of the business is limited to the life of the owner of the business. Then easy transferability of ownership interest. And other advantages, limited liability. They will not pay. There is no unlimited liability. It's limited liability. They will not use personal assets for to pay the debts, to pay for the legal actions. They will their they are only responsible to pay business debts for the amount of investment they made. So in the corporation, they have unlimited life and easy transferability of ownership interest, and they have limited liability, not like sole proprietorship and partnership who has unlimited liability. And in the unlimited liability means that the business will pay its legal debts from its personal resources, while limited liability means that they will only pay amount of legal debts up to the amount of their investment. That is the corporation, which is whose liability is limited liability, which means that they will not use their personal resources to pay out legal debts. And then the disadvantage is here, that the corporate income is double has a double taxation, which means that the earned income of a corporation is double is taxed twice by the government at the corporate level, either at the corporate level and at individual level, which means that the at the corporate level means that the corporate income is taxed and then they analyze how much their total profit is left, and then from the earnings they pay out some of their earnings as a dividends to the shareholder. So in this way we can say that the earnings of the corporation is double taxed by the government, is taxed twice by the government at the corporate level and at individual level. It has a more complex and time consuming, it is more time consuming. Corporation, building a corporation takes a lot of time and it has a complex structure. Then we have a hybrid form of organization. And in the hybrid form of organization, we have limited partnership, limited liability partnership, limited liability company, and professional corporation, and professional, which is also called professional association. In the limited partnership, it is a bit different from the general partners, because in the limited partners, has a limited liability, but the general partners who has unlimited liability, they have control over the firms. They have they limited partners have control over the firm, but less control over the firms than the general partners. They have they are unwilling to give up all the control. They have no control over the firms, but yes, but they have some of the control over firm, but maximum control. General partners, they keep their maximum control over firms. They accept majority of the business risk, and in the limited partners, their returns are limited. I will explain it again. In the limited partnership, limited partners are those partners whose liability is limited to the amount of their investment. They have control over the firm, but their control over the firm is limited than that of the general partners. Their returns are also limited. And while in general partners, they have unlimited liability and they have maximum control over the firm. They accept majority of the business risk. While limited partners, these are the partners, they usually work in real estate and oil and manufacturing firms. Oil manufacturing firms, so in these type of companies, mostly limited partners, they work. And we have limited liability partnership and limited liability company. Limited liability for the business debts, they have limited liability partnership has limited liability like that of the limited partners, and it combines the limited liability advantage of a corporation with the tax advantage of a partnership. They have an advantage like a corporation, which is the limited liability. Limited liability partnership has an advantage of a limited liability. Again, I'm telling, it has an advantage of a limited liability, which is similar to the advantage of a corporation, and they also have a tax advantage like a partnership. They have two advantages. One advantage is similar to the advantage of the corporation, and another advantage is similar to the advantage of a partnership. So limited liability, which is the advantage of a corporation, that limited liability partnership also have. And other advantages, tax advantage of a partnership, which limited liability company or limited liability partnership, they have in their structure, in their partnership structure. So another component is professional corporation or professional association, a type of a corporation common among professionals that provide most of the benefits of incorporation but does not relieve the participants of malpractice liability. These professional corporation and professional association, they have the same advantage like a corporation, but they do not allow their partners to malpractice liability, which means that they have a controlling mechanism. These all partnerships have a controlling mechanism, and likewise professional corporation and professional association, they have controlling over their partners to not malpractice liability, which means that they try to control, they try to increase their investment, their earning, they try to increase their earnings, their income, and in order to avoid waste or a cost that is which that have a harm for the that is harmful for the organization. So they try and they try to avoid those type of the uh, un, unbearable circumstances which is not good for the firms. So they try to control the partners. They have a controlling mechanism over the partners to use to not malpractice liability, and which means that if they have a good credit terms, they decide an effective credit terms. That is the professional corporation and professional association. Then we have finance in the organization structure of the firm. How finance works in the organizational structure of the firm. Here we are studying about the role of finance. Here we are studying about the role of finance in organization structure. Here the first one is, I will make it more closer, board of director. Then we have president and vice president finance. So vice president finance, they report to the president. They give financial reports to the vice president finance. First of all, we have board of directors, then president and vice president finance. Vice president finance, they give reports to the president, and vice president finance subordinates have treasurer and controller. These are the subordinates of vice president finance. A treasurer is used to supervise, direct, and control credit management, inventory management. They direct and control capital budgeting. They make an effective capital budgeting. They also they are also responsible for cash and marketable securities, for issuing cash and marketable securities, for planning an optimal capital structure where stocks and bonds, how much percent of the stocks and bonds should be raised by or should be undertaken by the company for good investment, and so that the company have a better has a better outcome. So for that purpose, what they do, these treasurer, they do controlling over credit management, capital inventory management, capital budgeting, and they also control cash and marketable securities.